Jay, one of the things that you pointed out in your note to us is that tighter liquidity, not interest rate increases, is the key driver of the volatility we've been seeing in tech and other risky areas like crypto. Explain more of what you mean by this and what this means in terms of what headlines investors should be looking out for coming from the Fed that may stir up more volatility in these market areas.
Thanks for having me on. What we view as the key driver of the shift to momentum stocks was really this unprecedented liquidity that the Fed was injecting. And the minute it became obvious that they were going to withdraw that liquidity, which is at the end of November, that's when you saw this rotation out of tech and into value started. So the Dow has outperformed the NASDAQ by over 7.5%. And so that's the real driver, is liquidity. That tends to drive momentum, and that tends to drive the risk premiums down. There's a urban myth that tech stocks have much more interest rate sensitivity than other stocks. But if you really do the analysis, and we've done that, and calculate the duration, which is the way to measure interest rate sensitivity, normal tech stocks that trade on the stock exchange have similar durations to value stocks. It's only private companies that have payoffs 30, 40, 50 years that might be a little bit sensitive to that. But that's not the key driver. It's really tight Fed.
Jay, there was something that jumped out in the notes that you sent us that I wanted you to help us explain and help us understand, which is when the 10-year yield is above 2%, and you use the word significantly, so I'm curious if you can put that into context. $52 trillion of global pension assets will rebalance and reallocate into treasuries. What does that do to liquidity when that moment happens?
Well, it doesn't have a big impact on liquidity. There will be some selling of stocks, but then if we're correct and there is a lid on interest rates, so 2% on the 10-year-ish, and that would imply a 30-year almost 3%. What happens is the pension funds, first they need to rebalance every quarter. So if stocks have outperformed, they sell and buy bonds. But if bonds have underperformed, they're going to buy those. But what we saw in the past is that the boards of these gigantic pension funds decide, well, why are we only 28% bonds when the 30 years at 3 and our bogey's 6? So we expect them to raise those allocations. And then the final reason we don't think rates are going to infinity is that the rest of the world, particularly in Europe, is very slow, partly because of the blown energy transition. So we see U.S. rates being very competitive globally as well.